Wonder why price comes back to the same candle before making the real move. That candle isn't random. It's not just structure. It's a mitigation block, one of my favorite entry models to catch perfect trades in the market. These are the hidden zones where institutions quietly clean up their mess, reload their weapons, and continue the trend like nothing ever happened. In today's video, we're diving deep into mitigation blocks, from A to Z, what they really are, how smart money uses them to manipulate price, how to identify them before they trap you, and most importantly, how to use them to enter high-probability trades. I'll also share the key rules and criteria that separate a random candle from a powerful, institutional-level mitigation block setup. We always appreciate your support, so please give this video a thumbs up, and if you're new here, don't forget to subscribe. See you after intro. First, what is a mitigation block? A mitigation block is an area where institutional traders return market to mitigate or reduce losses from a previous losing position, while simultaneously entering and adding new positions in the intended direction of the trend. More importantly, it acts as a key decision point where institutions clean up previous drawdowns and gain better pricing before continuing the trend. In simple terms, it's where smart money sweeps up their mistakes and uses it as fuel for the next big move. Let's break down the psychology. Institutions don't always get perfect entries. Sometimes they enter too early and experience a drawdown in the market. When you're moving millions, even 20 pips of drawdown matters. So, what do? They return price to the mitigation block to close or reduce losing positions from earlier trades, refine entries with larger volume and open new positions to realign with the trend, and trap emotional traders who mistake the move for a reversal. And guess what? This move looks like a normal pullback. But it's actually a precision strike, masked as a retracement. Wait, so does that mean mitigation blocks are always about fixing losing trades? Not really. Sometimes it's not about losses at all. In smart money terms, mitigation simply means returning to a zone where orders were only partially filled, or where price moved away too quickly before they could fully execute. So even if they're in profit, they still might pull price back just to finish the job. Wait, isn't this just another order block? No. Here's the key difference. Order blocks are where institutions first enter their positions, often at the origin of a trend, and they are decisional areas formed before institutional orders are executed. Mitigation blocks are where institutions return later to clean up unfinished execution, mitigate earlier positions, and refine entries after the market has started moving. So the order block is the first move. The mitigation block is the smart money revisit, the cleanup mission. So, a mitigation block is reactive, not initiatory. It is where smart money cleans up bad positioning or adds extra volume, not where they originally created the move. Let's get it crystal clear, so you can see this in action. Imagine market is in an uptrend, and the price is making higher highs. Then, smart money starts preparing for a reversal, so they begin accumulating short positions to create liquidity for large short positions. Smart money engineers a fake move down. This move sweeps lows, makes traders believe the uptrend is over, attracts retail traders to enter short positions. Then, price violently reverses up, stopping out all those early short sellers. This upward move is the illusionary continuation of the uptrend. Just after this upward manipulation, smart money delivers a true displacement down, making a market structure shift. Price then comes back to the mitigation block. Not to mitigate drawdown, but to fill unfilled institutional orders, trap late buyers. From there, price continues downward in the real move. At this point, smart money didn't lose money earlier. They used the fake move to generate liquidity, then return to the mitigation block to fill remaining orders and fuel the real displacement. So yes, mitigating drawdown can be part of it, but the primary reason is not recovering losses. It's executing full position size efficiently within controlled liquidity zones. Before going any further, let's see how to identify a valid mitigation block from the candlestick perspective. From the candlestick perspective, a mitigation block is the last opposite candle or a series of consecutive opposite candles that form a false move, and the displacement leg. So, what does it mean? A bearish mitigation block is formed when we have an obvious uptrend and price forms a swing high, then a swing low, followed by a lower high before a market structure shift with a bearish displacement leg that is closed below this low here. Your actual mitigation block will be the down close or series of down close candles between the first high and first low. In this case, it becomes these two consecutive down close candles, and we draw it from the first candle's wick to the second one's upper wick. So if you wanted to take advantage of this, you could set a limit order right here at the lowest point of the mitigation block, so when price comes back up once again into it would trigger our order and push lower. So this is how you would use a bearish mitigation block for a short entry. A bullish mitigation block is the exact opposite. For a bullish mitigation block, we need an obvious downtrend, a swing low, then a swing high, followed by a higher low before price makes a market structure shift with a bullish displacement leg that is closed above this swing high. So your bullish mitigation area will be up close, or a series of up close candles between this first low and first high, and again, we mark that from wick to wick. To take advantage of a bullish mitigation block, you could set a limit order at its highest point and wait for its activation. So now, let's break down the key criteria and rules that help us identify valid and high-quality mitigation blocks, especially the ones with the highest probability of success. But before we continue, if you're trading, rule number 1, look for mitigation blocks around higher time frame areas of interest. The best mitigation blocks don't form randomly in the middle of nowhere. They form inside or right after tapping a major higher time frame zone, like an IFC candle, a supply or demand zone, or right after a liquidity sweep of a key swing high or low. These mitigation blocks carry institutional significance. Why? Because institutions are already interested in those zones. They're watching those levels, planning entries or exits, and managing risk. That makes any mitigation block formed in or around those zones way more powerful. So when price returns to that block, in confluence with higher time frame logic, it becomes a high probability continuation point in the direction of the smart money move. Rule number 2. Expansion move must not sweep liquidity. This is a crucial filter for validation. A valid mitigation block must be followed by a clean expansion move. But here's the key. That move must not sweep liquidity in the opposite direction. In a bearish scenario, the expansion leg should not take out buy-side liquidity. Why? Because if the expansion moves sweep liquidity before the real displacement, it likely means smart money has already taken what they needed, and they won't return to mitigate anything. The opposite is true for bullish scenarios. The expansion move must not sweep sell-side liquidity. Rule number 3. Price must break and close beyond the mitigation block, with the body of a candle. A mitigation block is not valid the moment it appears on your chart. It only becomes legit once price confirms it with a body closing beyond it. We're not interested in just a little wick tapping into it. That's not confirmation. That's hesitation. If price breaks the mitigation block with a wick only, and the body immediately closes back inside its range, that's not confirmation. That's a liquidity grab or fake out. So always wait for a body close beyond the block. No wick games. No early entries. Let the candle speak. Rule number 4. Price doesn't always respect the wick. Keep in mind that price doesn't always react perfectly from the wick. It can react from the candle body or the midpoint of mitigation blocks. Because institutional orders are often spread across a range, not placed at one pixel-perfect price point. That means price can react from various parts of the mitigation block, including the wick, the candle body, or the equilibrium level, which is the midpoint of the entire block. Rule number 5. The mitigation block must be unmitigated. This rule is simple, but absolutely critical. For a mitigation block to be considered valid and high probability, it must be unmitigated. That means price has not returned to the block yet. It hasn't touched, tapped, or partially filled that zone. Think of mitigation blocks like one-time use tools, much like order blocks or fair value gaps. Once price returns to that area and interacts with it, the smart money objective is complete and the edge for new entries is gone. So what's the takeaway? If price has already tapped the mitigation block, even slightly, do not treat it as a valid entry zone again. Look for fresh and untouched blocks if you want to stack the odds in your favor. We've covered the logic, the rules, and the psychology behind mitigation blocks, but theory alone doesn't make you profitable. Now let's check out some trade examples and see how mitigation blocks can be used properly to execute trades and solidify what we have learned so far. Here, we have the Nasdaq 1-hour chart displayed on the screen. As you can see, the market's overall profile is bullish, since the price has created multiple bullish breaks of structures. Now, if we take a closer look at this sharp bullish expansion, we can see that it has created a bullish break of structure by breaking and closing above this swing high. This strong bullish movement has left an unmitigated demand at the extreme, formed by this large red candle. We expect that the price will tap into this zone, get reversed, and then bounce back up and continue its bullish trend. Once the price enters the fresh, extreme demand area, I zoom into a lower time frame, typically the 5-minute time frame in this case, to closely monitor the price action within the hourly demand and look for any signs of a market structure shift as the confirmation, and also look for an entry model to go long. Here, we can see that the price has created a market structure shift and a PD array, which in this case is a mitigation block. We have a swing low, followed by a swing high, then a higher low, and immediately a reversal with great displacement. Note that this is different from a breaker block because, with a breaker, we look for a lower low to be formed, not a higher low. These last 3 consecutive up-close candles represent the 5-minute PD array, which is the mitigation block. I'm setting my entry at the highest point of the mitigation block and placing my stop loss right below this swing low. For the take profit, I'm targeting the closest buy-side liquidity above this swing high on the current time frame. Now, let's play out the trade and see what happens. As you can see, my long order has been triggered and price eventually hit the TP. That's it, traders.